This video covers the use of accounting analysis to assess credit or financial risk. To illustrate how ratios relate to financial risk, let's look at how financial ratios vary with credit ratings. Standard & Poor's credit ratings vary from AAA for very low risk to companies that are in default. The relatively low-risk bonds are investment grade, and the high-risk bonds are speculative grade or junk bonds. First, looking at sales volatility, note that firms with high credit ratings tend to have more stable sales. The current ratio doesn't quite line up with ratings. For example, AA firms have a lower median current ratio than BB firms. Some of this is because companies with high ratings tend to be more stable and they need less cushion for cash on hand. Plus, they have easy access to financing, as we saw with Kroger. The higher rated firms tend to have higher coverage ratios and lower leverage ratios. Researchers have developed a few ways to combine financial ratios into composite measures that predict bankruptcy. We'll look at two of those, the Altman Z-score and an index from a 2008 paper by Barath and Shumway. Altman Z-score computes an index of various financial ratios to give a measure of financial safety. In other words, a high Z-score indicates low risk. For Kroger, we have a Z-score of about 4.02. To put this into perspective, a rule of thumb is that numbers above 2.99 are low risk, and numbers below 1.81 are high risk, and numbers in between are indeterminate. Technically, I should have included something for non-controlling interest in the total market value of equity. The easiest estimate in this case is the book value of the non-controlling interest, but as with most companies, this impact is immaterial for Kroger. On the plus side, the Altman Z-score is fairly easy to compute. On the downside, it doesn't perform very well. This leads us to the next model by Barath and Shumway. The starting point is an estimate of the probability of default under similar assumptions to the Black-Scholes option pricing model. A default occurs when the overall value of the firm is less than the face value of the debt. The estimated probability of default within a year depends on estimates of firm value, its debt due within a year, its expected stock return, and the volatility of asset returns. The capital Phi represents the standard normal distribution, which you may remember from your statistics course. Barath and Shumway provide simple measures for these inputs, which I give in the spreadsheet that accompanies this video. The input to the normal distribution for Kroger's default probability is negative 7.13. The estimated default probability is then the same as a normal random variable being about 7 standard deviations below the mean, which is about 0. Barath and Shumway found that you can better predict defaults using an index that combines the estimated default probability with additional market and accounting metrics. These include the market value of equity, Barath and Shumway's estimate of the debt due within a year, the volatility of stock returns in excess of the market, and net income divided by assets. Higher levels of the index reflect more risk, so the index increases with the estimated default probability and the estimated debt due within a year. The index also increases with the stock return volatility, which you can see by the fact that the negative coefficient is divided by volatility, so that a higher volatility results in subtracting a smaller number, which gives a higher index. The index decreases with the company's market value, its stock returns in excess of the market, and a return on assets type measure. To put Kroger's number into perspective, this chart shows the out-of-sample results comparing the performance of Barath and Shumway's index to two other estimates of default risk. About 76% of firms with the default had a Barath and Shumway index in the highest decile. Another 11% are in the second highest decile, so that about 87% of defaults are in the top 2 deciles of the Barath and Shumway index. Kroger's index of -2 is in about the 5th decile, indicating a fairly low probability of default. Despite its high leverage, Kroger appears to have a low bankruptcy risk based on both of the composite bankruptcy scores. This completes the video on measures of credit risk. If you want to maximize the value you gain from this material, begin applying these tools immediately to analyze some of the companies that you're interested in.